Welcome to Great British Accountants. I am Sterling Libs, and in this video, we are going to explore dividends and the distributable profits trap. Here is the scenario. You are a single director company. You paid yourself a dividend over the summer, but due to coronavirus situation, your company doesn't have distributable profits to cover it, and you can't afford to repay it. What should you do? Coronavirus has brought harsh trading conditions. The effect of the pandemic on your business will need careful consideration when it comes to preparing the accounts. Assets and liabilities will need particular scrutiny, and in some circumstances, so will the question of whether business can carry on as a going concern. The impairment of non-financial assets, including goodwill, will be an area of particular focus due to the economic downturn. If you have always pursued a low salary and high dividends remuneration strategy to pay yourself, there is a risk that there won't be enough distributable profits to cover dividends. We won't cover the rules in detail here, but it's always important that you are aware of the correct procedures around declaration and payment of dividends. Things like having the relevant accounts on which to base the decision to pay a dividend. And remember also that companies are only permitted to pay dividends out of distributable profits. In addition, under common law, a company can't lawfully make a distribution out of capital. Where a director shareholder receives a dividend when they know or there were reasonable grounds to believe that the distribution was unlawful, they must repay the dividend to the company. But in the current circumstances of the pandemic and such, you may be strapped for cash and simply unable to repay it. That leaves you in a position where the dividend has effectively become a loan to you from the company. So, what happens then? What do you do? The legal position here is complex, involving consideration whether a dividend has been properly declared and whether it was clear to the directors, in this case you as the sole director at the time, that there were insufficient distributable profits in reserve. Where there are interim accounts showing insufficient reserves at the time, the distribution is likely to be illegal. If the company is a closed company, essentially a company controlled by 5 or fewer participators, you need to be aware of the potential of Section 455 charge. Unless the loan is repaid within 9 months of the company year end, there will be a 32.5% tax charge under Section 455 Companies Act 2010. This tax is due and payable when corporation tax for the period would normally be paid. Under Section 456 of the Companies Act, there are some limited exceptions to the Section 455 charge, but they are unlikely to apply here. Another snag is the possibility of a benefit in kind charge in respect of beneficial loan interest on you as the director shareholder. The good news is that there are some exceptions here, including where total loans are under £10,000. HMRC's Employment Income Manual, EIM 26132, gives some detail, and you should get some time to refer to it. You can just Google it online actually and have a look at it. The ideal situation would be for you to repay the loan before the Section 455 charge kicks in. This gives you at least 9 months from the company year end to find the funds. If you can't repay the loan, there are various options. It would usually be possible to vote a dividend to credit the account, which obviously we are ruling out here, or a bonus. The bonus route, however, would be taxed as employment income, attracting a higher national insurance charge, both for the director and the company, and losing the advantage of the dividend allowance. Another possible solution is a loan waiver. Essentially, that means the company writes the loan off. This must be done formally by a legal deed. Otherwise, the liability still technically exists. As far as the company is concerned, the waiver isn't deductible for corporation tax purposes. A loan waiver is potentially beneficial when dealing with a loan to a close company director shareholder, because the waiver will normally be taxed as dividend income under Section 415 Income Tax Trading and Other Income Act 2005. The alternative would be to treat it as employment income. If you opt for the loan waiver solution, be aware that Section 415 only applies for income tax purposes. HMRC may argue that the amount waived is subject to national insurance as earnings. It successfully argued this in the case of S. Fraser versus HMRC 2011 TC 00923. In that case, the fact that the waiver had not been discussed by shareholders at a general meeting was held to support HMRC's position. So, it is important to have minutes of any loan waivers and agree these in your AGM before undertaking the deed of waiver. Don't forget that common law capital maintenance requirements apply even after the balance sheet date. If there are events after the accounts that require an adjustment, you will need to tell this to your accountant, who will then revisit the situation accordingly to check that the steps you have taken are still effective. If you as the director reasonably believed that there were distributable profits at the time of the payment, the amount should be reclassified as a participator's loan. You could then consider using a waiver to write this off. You see, this is some bit of tax planning here. However, you need to check that there are no insolvency proceedings commencing or likely before doing so. This information was brought to you by Great British Accountants. We are business cash flow specialists and tax advisors. We help business owners to have strong financials and profitable businesses. And we ensure that we help them mitigate their exposure to high tax situations, thus helping them not to overpay tax but pay only what they should legally pay and not a penny more. If you need help or support to be more profitable in your business or to stop your business losing money unnecessarily, why not call us on 0208 146 0545 or mobile 079 7055 0865. Or you can also email sterling@greatbritishaccountant.uk. You can visit our website at www.greatbritishaccountant.uk. And we can come and do an audit of your business systems and processes to see where you are losing money and also show you how to fix it. This audit will be free of charge. You have nothing to lose but much to gain from the report we will give you. So I hope you'll take us on our word and get some help if you need it. Till next time, be sure to take good care of yourself and your business. Thanks for listening.